Wall Street hoping falling interest rates and strong corporate earnings will power another year of stock market gains. After 3 years of double-digit percentage gains, the S&P 500, Dow, Nasdaq enter 2026 with high valuations. Now, last year, the S&P 500 rose 16%, the Dow gaining 13%, and the Nasdaq jumping 20%. The market rally could continue, but many wonder if the momentum can last. Well, joining me as we kick off the new year is Sonu Varghese, Vice President and Global Macro Strategist at Carson Group. Good morning, Sonu. Happy New Year, and thank you so much for joining me. Well, the first full trading week of this year has been jam-packed with data, new record highs for the Dow, S&P 500, but also anticipation of stimulus, not to mention geopolitics being front and center again. So what is your U.S. forecast for 2026?
Well, thank you for having me. It's nice to be back, Remy. Happy New Year to you too. We expect another good year for the equity market. Last year, we expected above average returns. That's what we ended up with, despite a lot of volatility in April after Liberation Day. And momentum begets momentum more than anything else in markets. And we have pretty solid momentum coming into this year. And so for this year, we don't expect a recession. And because of that, when you don't have a recession, usually you see above average returns above 10%. So our expectation for the S&P 500 in 2026 is 12 to 15%.
And so new economic data gaps from last year and, of course, economic changes are still playing out. So how strong is the U.S. economy heading into this year? And, of course, tell me your expectations ahead of tomorrow's jobs report and what all of this means for investors out there.
Our view is that, look, the economy is hanging in there. And by that, I mean, 2023, 2024, we saw above trend economic growth, real GDP growth clocking in close to 3%. That slowed down in 2025 to about trend growth, close to about 2.5%. And we think this year will be more of the same. Nothing close to, recessionary levels. That's what our own leading economic index tells us. Here's a stat for you, Remy. In 2025, we just got the data for auto sales. 2025 auto sales was 16.1 million annualized per month, right? That was about 2% above the 2024 pace. And this is despite a higher unemployment rate. The unemployment rate rose to 4.6%. Now, that's where some of the risks for the economy lie in the labor market. But we have been in a low hiring economy for a while. The good news is that we've also been in a low firing economy. And I think that's what the data will tell us tomorrow. We expect the unemployment rate maybe to pull down a little lower to 4.5%. But we're kind of in a Goldilocks scenario here. If the unemployment rate stays at 4.6%, if hiring payroll growth is a little weaker than expected, say it comes down to around 30, 40,000, still positive, we think that increases the odds for the Federal Reserve to cut in January. So that's another potential tailwind. This Fed is easing. And as the saying goes, don't fight the Fed if you're invested in the equity market.
Yeah, and Sonu, speaking of policy tailwinds, there are also other tailwinds that we're watching. So in addition to rate cuts, there are also tax cuts and tariffs. So give us your take on these two moving forward.
Yeah, I think fiscal policy, we have, deficits running above 6% of GDP. That by itself is a boost to profits, right? And we think this year, the tax cuts passed in May, June, July of last year will come into effect. And a lot of those tax cuts are retroactive to 2025. So when people do their taxes over the next 2-3 months, they will get a larger than expected, a lot of households will get larger than expected refunds, right? There are deductions for tips, there are higher deductions for seniors. A lot of households will be able to deduct more of their state and local income taxes as well. That deduction is going from 10,000 to 40,000. So that's a potential tailwind for consumers with these excess refunds that come come by a check from the Treasury Department. So that's fiscal policy there. There's a potential tailwind. I already talked about the Fed. There's a tailwind of, Fed policy rates going down even further. We expect maybe about 2 cuts or so. Then just coming back to the economy, the global economy, where last year we saw a global bull market. The global economy, what we are seeing in our data is that activity is picking up. And that's a tailwind, obviously, for global equities, international stocks, but it's also a tailwind for US stocks because more than 40% of revenues come from outside the United States. So, a few tailwinds here, and that's why we are positive and bullish for the stock market in 2026.
Yeah, and Sonu, you mentioned a key factor, and that is international markets and emerging markets in terms of equity market performance. And I think, as you mentioned, 2025 was a reminder of the importance of diversification across asset classes, not just equities, but given the performance of what we saw in precious metals. So before I let you go, about 60 seconds here, what does a well-diversified portfolio actually look like in 2026?
We like equities. Obviously, we are overweight equities, but we are neutral, US versus international equities, which means we have about 70% exposure to US equities, 30% exposure to international equities. We are slightly overweight developed market equities simply because we think they offer a little more diversification. EM tends to be tied to the AI story as well, across China, Taiwan, South Korea. And we already have a lot of AI exposure through tech companies in the US. But on the diversifier side, we're in the camp that diversifier diversifies. You want bonds in there, but we think this will be a period of slightly inflationary growth. So we have some cash in there too, but we also have managed futures and assets like gold as well. We've had gold for a few years, for about 3 years now. That served us well in the portfolios. We continue to hold it.
Okay, Sonu, always great talking to you. Thank you so much for joining me this morning, and thank you so much for sharing your insights as we kick off 2026.
Thank you.